Good evening, ladies and gentlemen. Can I welcome you to the Car House Centre here in Doncaster. Thank you very much for making the effort to come along this evening. Before we start, before I introduce my colleagues on the top table here, just a few housekeeping rules. We're not expecting the fire alarm to be tested this evening, so if it does go off, we clearly need to take it seriously. As you can see there, the fire escape, if we could leave by that door and congregate at the far side of what was the school playground here many years ago, just to that far side, well away from the building. If you need the toilets, if you go back outside of this door and turn left down to the end of the corridor and turn left again, the toilets, both ladies and gents, are situated in that area there. A couple of other issues. You'll see at the back two presentation screens. One is from South Yorkshire Fire and Rescue and one is from the Doncaster Safer Neighbourhood team. Please take time after tonight's formal proceedings to go and speak to the people who are there. Julia, one of my colleagues from Fire and Rescue, will give you plenty of very useful information in respect of fire safety in the home, and if you need any advice, I urge you to go and have a word with her. On coming in this evening, you were given a survey form which allows us to try and improve on events like this evening, but also gives us some very useful information about how we run the service. So again, please take time to fill that form in, and if at the end you could drop it in at the box or to one of my colleagues at the back of the room there, that would be most helpful. Just in terms of the programme for this evening, I'm going to sort of act as the David Dimbleby. I'm going to do the MC bit, and I'll try very hard not to be rude to anyone, but if I am, by all means, collar me at the end. Equally, I'd also urge you, there's a question and answer session right at the end of the meeting, and please be patient. We've received a number of questions from members of the fund already, and we're going to try and incorporate some of those questions within the presentations that you'll get this evening. But there will be the opportunity for yourselves from the floor to ask questions here. The issue is the buses are returning around about 8 o'clock, and we very much like to feed you for having made the effort to come here this evening. So what I'm hoping to do is to close the formal part of the proceedings around 7:15, if that's okay. Colleagues from the pensions service are here, and if you do want to ask any questions, then clearly when we've finished the formal part of the meeting, then there'll be officers available to speak to if you wish. Could I introduce the top table here? On my far right is Councillor Richard Wraith, who is the Vice Chairman of the Pensions Authority and an elected member for Barnsley Council. On his left is Councillor Martin Lawson, who is the new Chair of the of the Pensions Authority. Sorry, the day job kicking in there. Of the Pensions Authority. And Martin's going to give you an introductory welcome in a short while. To his left is Gary Chapman, who is head of the Pensions Administration for the Pensions Authority. And to my immediate right is John Hattersley, who is the Fund Director. Both John and Gary are going to give you a presentation in a short while. Just before I ask the Chair to make his introductory speech, just to give you a bit of background to what's been happening over the last year. Dave Wilkinson, who was our pension fund manager, who's actually in the audience this evening. I don't know if it's a case of poacher turned gamekeeper or gamekeeper turned poacher, but David retired from the organisation, and we undertook a slight restructure in as much as John assumed the role of fund director and Gary head of pensions administration. And I'm sure if the opportunity arises this evening and you want to know a little bit more, they'll explain the reason behind that. So without further ado, I'll hand you over to the Chairman of the Authority, Councillor Martin Lawson.
Thank you very much. As has been already said, there's been a change with the staff on the Pension Authority, and as you can tell, there's been some changes on the authority board. Following the local government elections in May, Andrew Sanger stood down as chair of the authority and I took over. And I'd like to thank Andrew for his hard work over the last few years. And the fact that he stayed on, I can hopefully get a bit of the pearls of wisdom from him over the forthcoming years. And I'd also like to thank all the other councillors who've been on the board for the last year and this year. As I'm new to the authority this year, although I've been on it before, what's happened in the last year, I've been glad that I've got some notes that help me on this. It's very unusual for me to have any notes at all, but maybe it'll keep me to being short, because I'm sure you want the food afterwards rather than hear me. Last year was very much a year of two halves for the authority. The first half was to do with the evaluation of the fund, and funding level was calculated at 79%, which was not fantastic, but it wasn't unexpected, but it was far better than a number of the other authorities. We've been grappling with the cuts that have happened everywhere, and we're pleased to report that actually with the detailed discussions with the actuaries and the employers, that we managed to reach an agreement that the actuary and the employers, all the employers, were happy with. Then we've got the Lord Hutton report, which was put out a year ago, and it was actually finally issued in March. It's glad that Lord Hutton recognised the funding differences between the local government pension scheme and some of the other public sector schemes. It's taken the government somewhat longer to understand that there is a difference between them, but eventually, even, Eric Pickles, the penny seems to have dropped with him, even though we've got some other issues that I'll come on. The bottom line of what Lord Hutton said was that the LGPS should continue to be a defined benefit scheme, which I'm sure we're all glad of, but it should switch from a final salary scheme to a career average scheme, and I know there are pluses and minuses for that, depending whereabouts you are within the scheme. Since that time, of course, the government have decided that they want a £900 million cut in the LGPS scheme, and we are looking at the impact of that with the scheme. The fact the government actually only gave us the proposals on Friday of what they wanted to do about it, because they've decided that they will, I would say, cut short the discussions between the trade unions and employers and themselves and the actuaries of what should be done about it. But I will leave it to others and in future discussions about what is likely to happen to that, because I think it's still very much in the melting pot. Of course, we've also got a double whammy this year, you could say, that actually the investment markets are all over the place, and we've got the problems with the weakness of Greece and the euro and other European countries and banks, and that means that the interest rates are for some people okay at being quite low, but the difficulty of having problems with debt and low interest rates makes things even more difficult. I'm sure the situations will carry on for somewhat longer, and they're still unresolved, but so it's a very challenging year ahead, and I'm sure that my fellow members, and I'm sure the officers and actuaries and our other advisors will help to steer the fund forward in this next year through the headwinds and hopefully into calm waters ahead. Thank you.
Thank you. Thank you, Councillor Lawton. Could I now invite John Hattersley, our Fund Director, to give you a presentation?
Good evening, ladies and gentlemen. Commiserations to those of you who've had one of my speeches before. But I thought this year, just to make things a bit more lively than normal, we start off with a bit of fun. Now, fun, of course, is a variable term, so apologies if you don't find it funny, but never mind. A couple of investment-related quizzes. I don't know if you have the same feeling, but I feel these days that everything is based upon lists. It's partly a function of the internet, partly because so much information is readily available, but every other minute of the working day seems to be somebody on the phone asking about a survey, or will you do this, or will you do that? And as far as I can see, the only purpose of these surveys is to produce lists. And then you have another survey about the lists. So these three questions I'm going to ask you today are all based upon lists. Now, the answers I'm going to give you at the end are the list's answers. So if you don't think they're right, please don't get me. But they are related. First quiz question. Which is the most indebted nation on earth? Now, we're talking here about household, individual, and government debt as a percentage of GDP, i.e. basically the economy. There's some names there you may be surprised to see. Others maybe leap at you. I'll give the answers at the end of tonight's chat. Second question. We all know that economic power is moving away from the west to the east. It's a trend we've mentioned at these events before. The economies are certainly growing. The biggest one, of course, is China. So as an example of that, how many Chinese cities will have a population of more than 1 million people by 2025? As a clue, there are 35 in Europe at the moment. So how many cities will have a population of more than 1 million people by 2025? And there's a bonus question. How many Chinese cities will have a population of more than 5 million people each by 2025? This may be more at home for some of you wealthy individuals. How much is the value of a case of Chateau Lafite Rothschild 1982? The case was valued in December 2005 at £5,600. Now you notice there are some negative numbers there, some positive numbers there. As I've told you before, the prices of shares could go up as well as down. So I'll report on those answers at the end of tonight's presentations. I should add, by the way, that is not taken from my cellar. We've got that on a magazine. You've got a copy of the accounts in your handout, which may be easier to read than this. It's a rather busy slide. I apologise for that. The format is slightly different as well against previous years. And that's because of the introduction of a new accounting standard, which all local authorities have had to adopt this year. Those of you who've been merrily comparing the numbers on that slide against last year's numbers will see that they've been restated as well. We had to do that because, as I say, the rules changed. In theory, these changes are there to increase transparency and make accounts more comparable with those in the private sector. I can't actually see that. Certainly it's made it more comparable with the private sector, but we now have 24 pages of notes to the authority, to the fund's accounts. I don't quite see how that adds to transparency, personally. The new regime has raised all sorts of issues in accounting terms. What we now have to show, what we don't have to show, nominal entries in and out. Because the accountants like to work on an annual basis. They like to draw a line in the sand and say this is the position at a particular day, the 31st of March in our instance. But of course, a pension fund is a living entity, and a lot of people join a pension fund and remain in that pension fund for 40-odd years. So our timescales do vary from those an accountant's normally used to handling. So with that caveat, this is a position statement at 2 particular days in 2 years, the 31st of March. The first point I want to make about the accounts is you can see the contributions received, 232 million, were basically stable compared to the previous year. As you know, employers' contributions are fixed for 3 years by the actuary, and employee contributions are also set by law. So normally, employees' contributions rise in accordance with salaries, but of course, at the time of wage freeze, that doesn't happen. You may also like to note that, in fact, 25% of contributions came from employees, which is relatively low. Over time, the normal ratio has been 2 to 1. Employees are normally paid twice what the employees have done. And if you look at the various proposals coming out of government at the moment, which we'll mention later, that ratio is likely to get closer to 1 to 1 over time. Benefits payable certainly weren't stable over the period. They rose from 184 million last year to more than 211 this year. The biggest increases were in lump sum commutations and retirement benefits, now running at about 62 million a year, and higher pension payments, 144 million. Clearly, part of that increase is a consequence of the decisions of district councils to reduce workforces in response to the cuts announced by central government. So we can expect more of those over this financial year. Nonetheless, contributions were still slightly more in excess of monies going out, let's say about £20 million. But as a point of reference, so far this year, until the end of September, contributions were below payroll costs for the first 6 months of this year. So we weren't covering payroll purely out of contribution income this year. So where did the bulk of monies for investment come from? Well, the answer is investment income. That rose to 109 million during the year under discussion. More than half of that came from company dividends, about 63 million, 35 million from bond interest, and some 12 million from rents and property income. As we've already touched upon, investment markets got off to a slightly shaky start in 2010, and we're never likely to follow on the strong performance we saw in 2009 after the very poor performances in 2007 and 2008. Overall, most investment markets ended the year up higher than they began, and by the end of the year, as you can see from the bottom columns, bottom lines, the market value of the fund had risen from 4,082 million to 4,464 million, a rise of roughly £380 million. So on the face of it, a good performance. The fund did well. How was the fund invested as at the 31st of March? Those of you who've been to these events before will understand that the fund's investment structure is based upon a benchmark which itself is based upon the underlying liability structure of the fund. As you know, the art of investment is all about reconciling the lure of returns against the acceptability of loss, i.e. risk management. And as the fund matures, the requirement for income, regular and sustainable income, increases. However, we also have to be aware that there is a notional deficit in the fund, which is the gap between the value of the assets we hold and the size of the eventual payout we have to make, the eventual liabilities. And that gap can only be breached by investing in assets to produce above average returns. And in order to do that, the fund has to take on risk. So we take on risk to attempt to meet our expected returns but we do so in a very prudent manner. We diversify across asset classes. So this chart shows how that is done. Should bear in mind, of course, that risk cannot and indeed should not be eliminated. But it is prudent to ensure that within each of these asset classes, we don't take unnecessary risk. So within each coloured segment, we also diversify the portfolios across individual shares, across countries, across regions, across companies, across buildings, across properties. The returns achieved in investments reflect the degree of the risks taken. So last year, for instance, the overall return obtained from bond portfolios was 6.3%, whilst the returns obtained by UK and overseas equities were 9.3% and 9.8% respectively. As said, such broad numbers mark very considerable variations between various markets. For instance, in overseas equities, Japanese shares actually produced a negative 2.6% return in sterling terms, whilst the emerging markets portfolio produced 15.2%. Property had a good year. It returned 13.2%. Private equity was also good last year and returned 12.2%. Since the year end, members have discussed changing the benchmark in light of the actuarial valuation of March 2010, and a new benchmark is being introduced. And in fact, the team at Regent Street has just started work this month on implementing those changes. They are tweaks rather than fundamental changes, but they do alter the mix between the asset classes. This slide has been prepared by WM Services, which is an independent performance measurer, and it shows how the fund has performed against its own benchmark. No, it hasn't. Out of order, sorry, that's the one. Shows how the fund has performed against its own benchmark over the last 10 years. You can see that apart from the years 2004 and 2010, it has beaten its benchmark. So as a result, we are ahead of benchmark over 1, 5, and 10 years. Although the outperformance numbers look relatively small, when you're talking about a £4.5 billion fund, actually they are quite considerable. They're adding a lot of value. So last year, the fund returned 9.1% against a notional benchmark return of 8.3%. The average local authority fund returned 8.2%. This slide, also prepared by WM, compares the fund's performance with that of all other local authority funds. Now, again, those of you who've been bored to death before will know that you shouldn't directly compare one fund against another because our underlying liabilities profiles are markedly different. But it is reassuring just to see what we are doing against the universe. And you can see the fund has consistently outperformed the peer group. Again, the worst 2 years were 2004, 2010, but we ranked 19th last year, and over the last 10 years, we ranked 13th. When members received a presentation from WM last month, I say it is an independent firm of analysts, they quoted as saying, "The fund is producing above average returns for below average risk, and not every fund can do this. It demonstrates real skill in the management of the assets," for which I'm truly grateful, otherwise I'd be out of a job. Now, the chair hinted that things have been a bit awkward. 2010 is when we had the last actuarial evaluation. I don't really want to talk anything more about last year because last year is just last year. As I say, the fund is a living entity and hopefully will go on. But it can't escape your notice that stock markets have been very volatile and nervous. There are major economic issues out there across the whole globe. And whilst it can be exasperating, especially when you're in the office trying to invest in shares, and markets move up and down so swiftly and unpredictably, every news story generates some sort of trade by somebody somewhere. At least investors at the moment are recognising that there are broad issues out there. For a long time, over the last 6 months or so, it has appeared that the politicians, either here in Europe or the United States, don't quite understand the scale of some of the issues the world faces. And their inertia has certainly contributed to the unease and nervousness. And their inaction will ultimately mean that when a solution is found, it will be both more complex and much more costly than had they taken earlier action. But then, that is part of the democratic process. The electorate has to be carried along by coercion or by intimidation, really. This slide has been prepared by Mercers, who are the fund's actuary, and it just illustrates how dramatically the last 3 months or so have altered the investment market scene. You can see that there's been a period of stability. The blue line is corporate bonds, the red line is government securities, they're the safest of the safe. The yellow line are UK equities, i.e. company shares, which are risky. The pale blue line, the turquoise line, index-linked gilts, and the purple line, overseas equities. For a period of 7 months last year, equities underperformed bonds. Then there was roughly 7 months when markets moved broadly together, and then from July onwards, equities have fallen out of bed. The markets were spooked by the decision of one of the rating agencies, Standard & Poor's, to downgrade US sovereign debt by a notch on the 5th of August. They were spooked by the failure of the Eurozone politicians to address the debt crisis in Greece and the knock-on consequences for European economies. And they are spooked by all the consequences of that for European banks. Basically, markets were spooked. Now, I started off by referring to lists, so I'm going to go back to lists now. Day by day, share prices have swung violently by hundreds of points. For instance, during the first week of September, New York share prices fell by 3% in the first 90 minutes. 3% in the first 90 minutes of trading on the Tuesday morning. They climbed back up by nearly 3% on the Wednesday, only to fall back down by 3% on the Friday. Similar behavior was experienced in August. Prices have been more volatile certainly more volatile now than they were 20 years ago. 10 of the largest daily upswings and 11 of the largest daily drops over the last 30 years have occurred within the last 3 years. That may be a function of computers, maybe a function of short-term trading, but the volatility is increasing, which is why it is very dangerous to make decisions just based upon the outcome of a single day or indeed month. The total loss on the FTSE 100 index, that is the leading UK companies during the quarter, was 13.7%. That is the worst performance for 9 years. The last time it dropped like that was in the late summer of 2002. We weren't alone. Germany's main stock market fell by 26%, as did France's. Both of those markets had the worst fall since 2002. Both of those European indices have fallen more this year than they did at the peak of the 2008 financial crisis. In the United States, the S&P 500 index fell by some 13%, although that's not quite as bad as the 2008 experience. Now, in itself, that is quite a daunting slide. I've suggested you don't take one day's measure independently. But in terms of pension fund finances, this is a far more intriguing, important, and slightly depressing slide. The other side of the coin on equity price falls has been the dramatic decline in bond yields. Equities are risky assets. You get a better return on the long-term view, but they do go up and down a lot. Bonds, or fixed interest securities, are basically just there to pay you out a fixed sum every year, and then you get your principal back at the end of the period. And therefore they're seen as being relatively safe. And the safest of the safe are bonds issued by governments, and the safest of the safe are investment and inflation-linked bonds issued by governments. Because of that, actuaries tend to use bond yields as measures of liabilities. So your liabilities in the fund, which are building up, i.e. pensions to be paid, are costed on bond yields. So if bond yields fall, as they have done here, your cost of your liabilities increases dramatically. The lower the yield, the higher the cost, greater the deficit. This is a major concern for pension funds. Interest rates are at historically low levels, yields are historically low levels, therefore liabilities are increasing. Now, the recent announcement by the Bank of England regarding the reintroduction of what they call quantitative easing doesn't help. Because what quantitative easing does is keep long-dated interest rates lower for longer. Independent company called the Pension Corporation has calculated that the first round of quantitative easing added 74 billion to British pension fund deficits when it was introduced. This is quite important for developing planning over the next 3 and 5 years, because if we are entering a period of consistently low interest rates and low bond yields, we may have to re-examine some of those strategic decisions. Where is the fund now? Well, at the actuarial evaluation, it was valued at just over £4 billion. At the end of March, it had gone up to 4.46 billion. That's the number quoted in the accounts. By the end of June, it had gone up further to 4.5 billion. At the end of last month, September, it had fallen down to 4.2 billion. It reflects volatility. So on a bright note, just remember, it's only money. Thank you.
Thank you very much for that, John. And as I said earlier, you'll be able to ask further questions of John in the question and answer session. Before I ask Gary to stand up, just one apology, ladies and gentlemen. I should have said at the outset that tonight's meeting is being filmed. And the reason we're filming is predominantly because there are a number of people who would have liked to have been here this evening and couldn't actually make it. So what we'll do is put that on a social medium such as YouTube, so that other members of the fund who couldn't make it this evening can obviously view the proceedings and certainly the presentations. So apologies for not mentioning that at the outset. I'd like, if I may now, to invite Gary to give his presentation.
Evening all. Thank you. Before I start then, let's get a little bit interactive. Who was here when I last presented here 4 years ago? Come on. Oh, not many, not as many as I would have thought. Can anybody remember what the keynote speech was that evening at all? We had a guest from London arrive on train, come in, speak, and then leave for us. Well, we had Terry Crossley from CLG, and when I was looking back, because that was my first time of presenting at the AGM, so I was trying to look back to what I'd said, we were talking, believe it or not, about changing the pension scheme and paving the way for future stability and affordability for the long-term future for everybody. Well, the second part of my presentation tonight is talking about changing the pension scheme. And we're just 4 years into that. So it does really strike a chord as to the way things are at the moment. So John's depressed you a little bit, and I may depress you a little bit more. So without further ado, I'll just go into my first little bit, which is traditional, really, if you come to these things, which is to look at the performance arising out of our service during 2010-11. First thing is to look at membership, and it's been falling in terms of active members over the last few years. We had a slight peak in the previous year in 2010, but then saw a bigger fall of membership in 2011 to 53,597. Now, one of the main reasons for that, of course, is the downsizing by the local councils as a result of the spending review, and we're still in that now. If you look at the figures as of today, as I did this morning, we've got 51,205 of active members, and of course, that's a couple of thousand down on what it was at 31st of March 2011. So membership is changing, but as active members go down, of course, the other members that we have in the fund who are then either drawing benefits or leaving early and preserving benefits start to rise. So we've, at the period, at the 31st of March 2011, we've got 37,268 pensioners and 36,741 deferred members, all which we've got to service and provide information to, as you know, like yourselves. And those have increased too. As of today, pensioners are around 39,000 and deferred members 38,500. So as time goes on, if this continues, particularly as changes to the scheme comes, we may find that when I come to you in future that we're looking at a pattern of the active members going down during the period. Looking at our performance, which is something that we keep a very close eye on, we place a great deal of emphasis on meeting our targets of standard of performance for delivery of the service. And they're not easy targets to make. So whilst, you know, that looks good, 29,820 cases processed, 99% within our customer service published target, that is an achievement. We do have very tight targets which are either equivalent or better to whatever else goes on in the country at all other pension funds. So we're very, very proud of that performance during the year. And if you've been and experienced the service during the year, either asking for something or indeed retired or something like that, hopefully you were in receipt of something that you realise came on time and what you were expecting. But it's not always, we don't get it right every single time. Out of that number, you would say 5 formal complaints, which are where someone takes the thing to the next level. You know, we often have people come on the phone saying, where's something or other? And after having an explanation and so on from the staff, then they're happy and go away, and that doesn't turn into a complaint. But these are where things can't be sorted out at that first level. So we make sure our staff are actually empowered to try and sort things out. But if it can't be sorted at the first level, then we have to escalate it up to the complaints manager. So that's 5 formal complaints out of the 29,800 cases that we dealt with. And each of those people then got a full letter, an explanation, and hopefully were satisfied by the end of the letter being dealt with. The internal dispute appeals are not complaints as such. These are things of a regulations type nature where we've applied something that somebody disagrees with the way we've done it. It's not a customer service issue. We've said you've got an amount of money coming, and they said, well, I don't want that, I want something else. And these types of things then have to be dealt with, so we then have to hopefully prove that we were right all along and explain how. And sometimes people ask for things that just aren't possible within the scheme rules, and we have to point out then through a formal process that what the rules are and so on. During the year, we achieved the Customer Service Excellence Award, which again we're very proud of. That arose out of, and I may have told you this before in previous ones, where we gained Charter Mark, which is a government award for customer service. That Charter Mark morphed into Customer Service Excellence to change the way in which companies achieved the award and the criteria that you have to satisfy in order to do it. And we won the award, and we put that on our letters and so on, and hopefully it signifies to all that we are a customer service organisation with the customer at heart, and that's really what we're about. Benchmarking is where we compare ourselves against other local authorities doing the same job as us. We complete mammoth questionnaire of all the costs and performance of performance figures in terms of each particular type of case that we deal with, and a whole range of other information. We come out very well on that. There was in 2010-11, there was 59 other pension funds took part in the survey. They don't like league tables, so we're not really in a league as such, but as far as the overall costs come out, then we come out as below average cost for a very high performance. So we're below the average in terms of cost, but the service that we provide for that cost is at a high level. So again, that comes out pretty well, and again, we're very happy with that. We don't stand still. We like to move on and innovate and try and make sure that we're working smarter wherever possible to streamline our systems. Really what we want to do is spend less time sort of pushing paper and doing the things and playing with lists and things, as John would say, and really deal with the member and giving our staff time to actually liaise with the member and talk to the member. I mean, leading up to under the spending review, we saw almost every pensioner in one way or other, almost every employee who was coming up to retirement, and we saw them personally, and we went through with them what the benefits would be and their options that were available. And it's by innovating and being able to streamline our services that we're then able to fit the time in to do what I think is the real work, which is making sure that people understand the pension scheme and understand the benefits and the choices that they've got when they're coming to retire. So we've developed a system for our employers called EPIC, and it's a system that allows employers to submit changes online to us, and so that we get information when somebody either leaves, starts, or changes their contract of employment. Then we get the information faster onto our systems so that we can then update the records, so that if the member then asks us for information, we've actually got the correct record and the correct information to tell them what their benefits are. And that's very important, because you don't want to be telling somebody they're going to get something and then they find out that they're not actually going to get it at the end of the day. And this system that we've developed, which was for ourselves, provides lots of information besides member information coming the other way from employers. So we're trying to teach our employers what they need to know about the pension scheme and give them information that they can then use when making pensions decisions back at their offices. But it's also gaining very much interest from other pension funds. So we're starting to find ourselves as sort of market leaders in this type of thing, and it certainly, when we show it to people, it becomes the envy of, because they can't have such things in their offices. We're also spending a lot of time and have developed data analysis tools so that we've got members here and we've got members in the fund, and so we know about you, so we can profile you, so we can actually communicate with you properly, so that we're not sending you stuff that you perhaps think, well, what they're sending me that for? You know, we can target people, and we can also understand a lot better the data by running queries upon it to say, this don't look right. You know, before it gets to a stage where we might send out an annual statement that's then got somebody's pay that's inflated by 5,000 quid, and therefore the benefit's inflated, we can actually look at these reports and put them right beforehand, so we've got much better chance of getting the information out to people accurately and without then causing a fuss when it goes wrong. Webcasting. Who saw me this morning on the webcast? Anybody in the audience? Oh, well, you'd have seen I was wearing this shirt. But aside from that, we do webcast the authority meetings. So if you're interested, and if you're interested, all we need is an email address from you, and then we can, if you've got one, and we can let you know when the authority meetings are being held. But you can see the authority business taking place as it happens. You'd be able to see the chair and vice chair probing and asking questions of us, and me and John having to put reports forward on various things. And it certainly is becoming even more interactive than that, because this meeting this morning, and we didn't get any, and I'm not surprised, but it's a growing thing, you can even ask questions of the people while the meeting's taking place. So if you've got a spare hour, an hour and a half, they don't last that long, these meetings, and you want to dip into that, then log on. It's very useful, and you can take part and even influence maybe the decisions that are being taken by the councillors. Communications, big thing. These things were in operation when I started work a long time ago, and I guess some of you would remember these as well. I think that phone looks even a bit modern for when I started. But it's all changing, isn't it? I mean, we still do the traditional stuff, the letters, telephone calls and so on, and that, I guess, won't change. But times are moving on, and things are changing, and this is just a little bit of a flavour of what we're into and really how we're progressing with things. Email addresses, this is out of the whole fund, so it's not out of active members or pensioners or whatever, it's out of the whole fund. We've currently got 18,000, but that's 18,000 people we can communicate with electronically. We can do it to advise them of things like there's a AGM going on, or there is a webcast going on and things like that. As long as we're not getting into personal details, we can correspond with you, answering questions and so on, which is quicker, saves a stamp and all that. And importantly for us, it enables us from our communications methods to streamline and to save money by being able to send newsletters electronically, being able to make those newsletters a bit more interactive than the printed versions that you get. And we can do a range of things then, rather than just having to do a single purpose type newsletter, because we can pick a newsletter for a certain section of the membership and so on. Mobile phones, I bet everybody's got one, but we've currently got 12,000 members with a mobile phone number registered. And that's all right, because we can phone them if we need them, but the reason I'm putting it here is that we can text. And certainly with members who we've got ongoing cases with, we can text them and say, by the way, you should be replying to this. Can you send me a reply, please? And that's quicker for our staff to do. It's cheaper because we're not putting a letter in an envelope and posting it. And also, you're more likely to get a response, because when that beeps, people tend to pick it up. So it's a growing thing, and if we, through all our paperwork and so on, we're collecting these things. And over the years, if I'm still stood here in 10 years' time or so, I think those numbers will change, and the way that we communicate will be different. My pension, hands up who's registered for my pension? Not bad, could be better, but my pension is our interactive service where you can go online. If you're a pensioner, you can go online and check what pension we're going to be paying you this month. You can have a look at your P60s, and we store them all for you, so you can go on there. If you're an active member, you can go on and do what-if calculations, retirement estimates and things like that, and just generally see if the data that we've got for you is the correct data. And I'd like that to grow. We've not publicised it or pushed it too much in the recent years, because it needs a few changes to it. We don't develop it ourselves, and we're pushing to get it developed. But it certainly is something that enables a deal of self-service. If you change your bank account, you have to go through a rigmarole. If you don't use that, you have to get a form and sign it and send it in and post it. Here you can go in and change it. It's very secure, and it's done for you. So, you know, there are advantages to doing things like that. Got the website address on the bottom. Again, we push a lot of information there, news and things like that. And I'm continually at our communications team to keep it up to date and keep it fresh and make sure the content changes and so on. And lots of people have got websites these days. We've had them years, and I think we're on our 4th or 5th incarnation, and I guess we'll be changing it again in the future as the flavour of the month changes. But if you don't use it already and you need to know some information, there it is. Anybody not know what the 3 symbols to the right of the pensions are? That's good, I suppose, or it's sad in another way. This is social media, which of course, you know, is going off big style, and you see it on adverts, you see it everywhere really, and so we're no different. We need to try and exploit this big, massive market, because at the root of it all, it draws people together, and whilst some of these things started off life in entertainment and various other things, we can bring a business application to them, and for us it's finding out what our members want, allowing members access to us in a way that they want to be contacting us by, because even websites are kind of old-fashioned now. People don't go to websites for information. They log into feeds via Facebook and Twitter and so on and get information that way. So if we want our members to be fully au fait with what we're saying, and let's face it, we're going to have issues coming up in terms of explaining complicated things to scheme members, then we want to be involved in that. So you've got Facebook, you've got Twitter. I mean, I could be standing on my phone now just saying, at the AGM doing a presentation, and then it's there, and then the people who are logged in would get that information. It's very low numbers at the moment for the fund. We've only publicised it really during this year, and when you think about it, I suppose, for a lot of the membership, in their minds, pensions is probably not the first thing they're thinking of, particularly the younger end. But hopefully it's something that we can try and attract members into by putting the right type of content in there. But we've got 236 members following us on Facebook. We've got 69 on Twitter, which is not very many at all. And then YouTube is where we put last year's AGM. And since we put it on there last year, we've had 374 people upload and watch the video. So how many people came last year and have watched themselves on video? Anybody? No? Well, that's good, because that's people who couldn't attend then, you know. So, but if you do want to watch and see if you can see it back of your head, then obviously you can do that in a couple of weeks' time. So that's what we're doing on communications. I've talked a little bit about member profiling through the data analysis. It's where we can actually do newsletters. So if we're looking at people in certain age groups for pre-retirement, or we're looking about other age groups for people maybe wanting to pay additional contributions and things like that, we're able to do so. Opt-out strategy is something we've just firmed up during the year. We detected that quite a few people were starting to opt out, and it's probably not surprising in terms of the pressures that people are under from a financial point of view. In local government, we've had pay freezes, the threat of lost jobs which affect the family, and inflation and things like that. So we recognise that over the years we had a process within the office, but we never really had to worry about it too much, because there was only a minor level of opt-outs from the scheme. We started to detect that more people were opting out. So our strategy involves just not trying to grab people and say you can't leave, but really to try and make them aware of the benefits of the scheme and what they would be giving up by opting out, and really what it would cost to get the same level of benefit elsewhere, which, believe you me, is a damn fortune compared to what it is in the scheme. And really that's our strategy, which is to, across the organisation, wherever you phone into, wherever you visit, whichever office you visit, we will react in the same way. We've got a certain set of documentation that we can provide, and wherever you actually are within the county, you get the same level of advice. If you still want to opt out, then that's clearly a personal choice, and you're able to do that. That's going to come into more focus, we think, in the coming years, when we talk about the possible changes to the pension scheme, which I'll come on to in a bit. Consultation, and that's what we try and do. We not do anything without asking you about it first. And if you've ever had any of our surveys, and you've got one today, you know, you will see that we're trying to find out what members want. And if we want to do something new, we want to ask you about it to see whether it's worth us doing it in the first place. We've got a focus group in our active member database, so there's 200 active members. We've got about 200 pensioner members. We've got different ways of which we can consult through the targeted member profiling. We did a spot survey earlier this year, which we said if contributions go up by an average of 3%, would you opt out? And we were able to email over 2,000 members, got over 1,000 responses, which is good for a survey. And we got a good steer from the feelings of the membership of what they would do, and a lot of them would vote with their feet and go out of the scheme. So, it's very useful to do that, but it's also about the service we provide as well, to try and make sure that you're happy with what we do. And a volunteer we need. One of the consultations we've got is a pensions advisory panel, which meets quarterly with myself and John and chair and vice chair. It's made up of 6 union members, and then we've got 6 other positions which can be filled by pensioners and deferred members. And we learned this week that our deferred member no longer wanted to be on the group, and we'd quite like somebody to step into the shoes. Ideally a deferred member, but if not, a pensioner member will do. It's a role which you can come along, you can ask questions of us, you can scrutinise the reports and ask the councillors and give councillors your view of what's in them before they actually take them to the full meetings, and any other things that there are issues around the pension scheme. So there will be, on the back of your packs, there'll be an email address, and if you want to get in touch and you're interested in that, get in touch that way, or by all means let me know after we've finished. I thought you might be interested in this if you're already on pension or a deferred member. It's not accurate, I must say, but I wanted to give you a figure, and if we'd have been met last week, it might have been a bit more accurate. But CPI is currently in August running at 4.5%. That will mean that it'll be roughly around that in September, and it's September's CPI that then we use in terms of working out what pensions increase you'll get if you're on pension from April. So there it is. I was asked if there was any plans to recoup the year that you got nothing if you were a pensioner. Well, no, there ain't. Though in that year it was negative inflation, and that's why it was 0. But as you can see at the moment, that's what it is. So that's roughly what you'll be expecting from next April, but it will change slightly. I'll not leave this on too long, because it might send you all into a trance, but I just wanted to say, before I get into the future, that this has nothing to do and no effect with pensions in payment. So your pension that you're already receiving is safe. If you're a deferred member and you don't rejoin the scheme and you come to draw your pension, again, nothing to do with that, right? So, warning over. So, a little bit Mystic Meg, but not so far probably wrong, is what's coming up in the future. Kind of scares me, because we've got a lot of challenges, and we've got a lot of challenges that we've got to be able to get across to the membership and hopefully make them understand and allow them to understand and so on. But it just keeps us busy, unfortunately, and that's how we'll progress on that basis. So the short term, we've got something called auto-enrolment. So if you're still in a job and you're not in a pension scheme, forget the local government pension scheme for this moment, and you meet certain criteria, the employer has to enrol you in a pension scheme. If they haven't got a pension scheme, they have to enrol you in a government pension scheme. As for the local government pension scheme concerned, we've got a lot of people that are not in the scheme now, who will have to be auto-enrolled in the local government pension scheme. So this, when we relayed this to employers either last week or the week before, sort of nearly give them all an heart attack, because whilst the information's been out there, it's probably not really sank in that the responsibilities that they have with auto-enrolment are quite great, and it's really a responsibility for them and not for us. But it's something that we undoubtedly have to contend with, because it will auto-enroll people into the scheme. We'll have to deal with them. if they opt out, we'll have to make sure they're not on our records anymore. But of course people, and this is what the government's probably hoping, is through inertia will stay in the scheme and therefore have a pension. So the heart's in the right place with it. The way that it's being done is open to question, but it's something that will be a challenge for us. Annual allowance is something that affects, well, we thought it really affects high earners, but it just doesn't affect high earners. It affects people with lots of service in the pension scheme, and it's all to do with the amount of pension benefits you can actually build up in a single year. There was an allowance of 255,000, which really put it out of the context of local government pensions, which has now been reduced to £50,000, and it's quite easy within this actuarial calculation that you get to exceed this amount. And where that happens, our members will end up with a tax charge, which they'll either have to pay there and then, or by a reduction from their benefits. On whether they're, and it doesn't mean that when you're actually retiring, it can happen, say if somebody gets a promotion during the year from one salary to another salary, then a tax charge applies at that particular time in that year. So we're gearing ourselves up around making sure that people are aware of all that and systems are in place to do it. But it's one extra thing that we've got to deal with, and it's a challenge. I put possibilities, probably because I was writing this before last Friday when the announcement came and the consultation paper from the government about the short-term changes. The short-term changes are around because the government wants to recoup from local government pensions a figure of £900 million, and to save the taxpayer over the next 3 years. And as a result of that, the only way you can actually do that is to change the scheme in some way. The government originally, for the whole of the public sector, says the way we're going to do this is to increase contributions. We're not going to do anything to the pension benefits, we're just going to increase the contributions, on average 3.2%. And of course that's why we did the survey that I mentioned earlier. But for the local government pension scheme, it is very different in terms of composition to other public sector schemes, because we are funded. The others are not funded. We've got a pension fund that then gets invested and hopefully reduces the contribution level that people have to pay because John makes us a lot of money and so on. And so there was a recognition that the local government pension scheme could be treated differently, and we were then challenged between the employers and the unions to come up with a way of actually achieving the savings but without actually increasing the contributions on its own. Because the real fear, if you put contributions up by that level, is people opt out. And if they opt out, it defeats the object, because you then don't get the contributions from the people who stop paying. So what's been proposed from CLG is an increased contributions from 2012, but not as much as would be if it was contributions alone. The low pays will be protected. In our fund, around 50% of the membership, well, I'll say that differently, 30% of the membership wouldn't see an increase in contributions at all because they're below the level that has an increase applied to them, and 20% would see an increase of no more than 0.1%, so very little. But then after that, then contributions start to increase progressively through to the high earners who then take a real whack on the high end of that. This is out for consultation at the moment, but the suggestion is it's out for consultation, but it's going to happen. And I think we kind of used to that anyway, as experience has shown over previous years. A change to the accrual rate is being suggested, not from 2012, but from a later year. Accrual rate is the way in which the benefits build up. So we're a 60th scheme at the moment. We used to be an 80th with an 80th pension and a 3/80th lump sum. We've gone to a 60th scheme. To make the benefits worse, to change the accrual rate to save money, you'd move it somewhere. So you're talking about a 65th or a 67th or something like that. And these options are likely to take place from 2013-14. But there are a range of options being touted, so it's anybody's guess where it's going to go at the moment. but it's probably going to happen. CLG have not suggested, but the local government employers have suggested that a way of saving money is to change the normal pension age date. Currently in the scheme, and has been for many years, the normal pension age is age 65. There is a plan under the Hutton Review and what's expected later on that when state pension age change nationally, then the scheme will move with that. The suggestion here is to move it earlier so that state pension age would still be 65 for men now, but in the local government scheme it would be 66, which would mean for members to receive a full pension without reduction, you'd have to work to 66, not 65. But if you wanted to go at 65, you'd end up with a reduction from your benefits that you otherwise wouldn't get. That's going to come at a cost, and what we're seeing already are ballots from the unions that for strike action about that. They even balloted for strike action before the actual thing came out. But this will run during the year. Obviously the balloting, and it depends on whether they get the mandate from the union members to go on strike. But there is a day of action proposed for late November about pensions and about pensions only. And it's hoped, if it goes ahead, to be a national day of action across all the public sector unions. So we'll see. And then there's the threat of opt-outs. And, so if it does come in, despite union activity and so on, then we need to be on our guard for opt-outs, and we've got the strategy in place, should that be the case, so that we can actually try and at least put aside, don't get me wrong, I don't think it's as good at all, but the scheme, even with changes like that, is still a good scheme, and so that's the message that we need to get across. Looking a bit long-term, if you can call 2015 long-term, this is the fallout from Hutton. We're in a period now where we're getting closer to the overall feeling of what the scheme will look like. The Treasury are setting a cost ceiling which will determine how the scheme can finance itself within that ceiling. So we've got employees' contributions, we've got employers' contributions, and at the moment, employers can go through the roof. They can go to whatever is needed. The idea here is that you build a benefit package that works within a certain cost envelope, and you can then adjust the contributions within it whenever you need to. We should say at the outset there, at the moment, there seems to be a definite will to protect benefits that people have built up. So if you're still paying into the scheme, what you've built up to 2015 will remain as it is at the moment, based upon your final salary. That might not stay like that, because that's quite expensive, but that is what is being promised at the moment. So what we're talking about is new membership and service after April 2015, if that's when it comes in. And the contributions at that rate, you would think, once they've gone a certain way in terms of the current short-term views, that they ain't going to change very much. So I think what we set here, we'll probably carry through forward in the future. It'll not be final salary. It will be what's known as a care scheme, career average revalued earnings. And instead of working on final salary, what you do is you work on, you calculate benefits based on the salary that you add in each year, and then revalue each year as you go through your career. So instead of having the big spike that people get when perhaps if they get a promotion just prior to retirement, if you're lucky enough to do so, that spikes your benefits up where you've never been on that salary for very long, is this does it as a smooth way through a person's career. I've seen charts that for the lower paid, in the way that works, that they end up being slightly better off, whereas certainly the more higher paid you are, then that tails off and you're actually worse off. And within the scheme, and will be consulted upon, is a benefit package, because we assume, or we readily accept what's in the scheme now, like ill health retirement, the death benefits that are payable, and all the things that are in the scheme. Well, within the cost envelope, we've got to work out what you can actually put in that. So it might be a mix and match. You can't have one thing, but you can have the other, and so on. And when the consultation comes out, there will be really, I would imagine, upon a menu type set of options that says, what do you want in the scheme? Do you want that or do you want that? And so on. And we will, of course, communicate all this to everyone and make sure that you're aware of it. But there are challenging times ahead, no doubt. And I think that's it. Thank you very much.
Thanks very much for that, Gary. I'm conscious that John actually hasn't given us the answers to those questions at the outset, and given, as he said earlier this evening, that he was going to offer as a prize a case of wine from his own extensive wine collection, and we will hold him to those answers. Never seen the colour drain from a man's face quicker. Thank you to John and Gary for their presentations. Thank you to Councillor Lawton for his introduction. Apologies, Martin, for getting your name wrong at the outset. Not the greatest career move, getting the chairman's name wrong, is it? But it's over to you now. Any members' questions? We've got some microphones at the back of the room there. If you've got a question, please raise your hand. Please wait until the microphone is with you so that everybody can hear. Okay, John, there's a gentleman here at the front, and there's two gentlemen there. I'll pick you both up after this question. Thank you.
Can you hear me? Yeah. Have you got a contingency plan in the case of a Greek default? That's the one question. I did ask some other questions with regard to... Can I ask the questions here that I'd sent in?
Well, could I ask you to keep it to one question, because there are a number of people. If you've got supplemental questions, then by all means give them to us, and we'll try and answer them by post or by email, whatever's convenient.
Have you got a contingency plan in the case of a Greek default?
Greek default.
Well, we have taken... How do I put this? We don't have a contingency plan in case of Greek default because that is a Eurozone issue. In terms of investment market returns, that's already been taken on board. And the Euro stock markets have responded, as we saw in the slides. So we cannot predict what the European politicians are going to do. We cannot predict whether it will be a structured, orderly default of Greece. Certainly something has to happen in Greece. Whether Greece will actually leave the euro, which is probably something which the Germans in particular don't want to happen. But you've seen recently, with all the tensions within the member countries of the Eurozone, that it is not a politically attractive option for some of the northern countries to bail out what they perceive to be the rather spurious policies of the southern countries. So it is basically a political solution. Now, the euro has traditionally been seen as the second world currency after the US dollar. Despite all the problems that the US has in terms of its own deficit, the irony has been that in periods of nervousness, investors have gone back to the United States and to the US dollar because it is the largest Western economy in the world. So flight of safety has taken place to the US dollar. We cannot predict what will happen within the Eurozone, so we don't need to have a contingency plan per se. All markets are affected, all markets are interconnected, and again, as the slide showed, when equity markets fall, bond markets go up. So the diversification of risk across the whole fund, all the assets are there to act as a limiter in terms of volatile periods. So the answer to the question is no, we don't have a contingency plan if Greece falls out of the euro.
There's the gentleman right at the back of the room, and then you sit, then you next. Yeah.
Good evening. I wonder if you could give me an update regarding the Icelandic Bank and what's happening, please, because I'm rather concerned that I think they've got £30 million.
No. The situation is that the appeals from the bondholders of the two main Icelandic banks, Glitnir and Landsbanki, are being heard this month, and we expect decisions by the end of October. The preliminary courts have accepted that local authority deposits rank as priority claims, and therefore there's a very good chance that between 85 to 90% of deposits will be recovered from those two banks. The authority's exposure to Icelandic banks was 18.5 million in total. So far, we've got back 4.7 million. If the courts do uphold their process, we are confident, all things being equal, of getting somewhere between 15 and 16 million back. We are not acting alone here. The Local Government Association, the LGA, is acting as a coordinator for all local authority pension funds, and legal counsel have been in Iceland this month, as I say, as part of the appeal process.
Can I just say, I'm concerned about it being linked in the first place to the Icelandic people, as what happened in the late 70s with the Cod War, when the city of Hull got its fishing industry decimated by with the 200-mile territorial waters.
Well, obviously, with hindsight, it was a rash decision to put money with Icelandic banks, but at the time, options were very limited. It was a period of crisis. We couldn't find all banks at all places actually willing to take our money at the rates we needed, so it was one of the options, I'm afraid.
The gentleman on the back row, yes, just indicating there. Yeah.
It's in relation to contributions, as just stated this evening. New members and members that's paying in now, they'll be paying more contributions. But such as I and probably many more of our members, we don't pay any more now. We're receiving our pension. Will they subsidise us in the future? Which I think would be unfair to them.
Well, the actuary, when he's making his calculations, there are two parts of the contribution rates from the employer's point of view. There's past service and future service. So everybody's paying a bit for what happened in the past, everybody's paying a bit for what happens in the future. And clearly, one of the things the government is trying to do overall is to reduce the cost of pensions to taxpayers going forward. So all contributors are likely to pay more. I can't make a moral judgment on whether the young are subsidising the old, but that is a function of demographics across the whole world. And it's one of the problems all Western pension funds face, that the working population is declining as a percentage of total population.
Gentleman here, John.
Thank you very much. Good evening. The rate of increase of pensions has been reduced to the CPI rather than the RPI. Are there any plans to reinstate the RPI as the rate of increase?
No, I would say definitely no. Definitely not at the moment.
Not at the moment.
Well, there's no indication that that will be the case now that it's moved to CPI.
Are there any more questions? Lady, yeah.
Well, hello, Gary. Following on from the gentleman's question, I understand there's been a legal challenge between RPI and CPI for pensioners. Is that the same with local government? Certainly that way for the civil service?
I'm not aware of that either, John.
No.
I'm not aware of it.
Keep you posted.
Yeah, thank you.
Thank you. Are there any more questions? Gentleman, right at the back again. Could you just wait till you get the microphone?
Yes, certainly.
Yeah.
Could you explain to me why there's no investment between the Mersey and the Wash and the Clyde and the Forth? I mean, there's plenty of shopping centres like the Metro Centre, Meadow Hall and the Trafford Centre, and I wonder why you've disregarded the North East, Yorkshire and the North West. I know the So I say the money is down south, but I'm afraid, like the position is at the moment, it's not South Yorkshire's money, it's not your money, it's our money. And I think we ought to have a say that since 1984, this region has had a very checkered past with the political situation, and I just wonder why you're not investing in it.
If you're talking about the direct property portfolio, then clearly the reason why it is situated across the UK as it is to represent the best possible return we can get for the investments. Going across the diversification argument, the focus has been on the southeast of England because that is where the best returns from property investments can be obtained. There is a mixture of investments. It's done on a very carefully calculated basis. We pick across the various subsectors: retail, high street retail, out-of-town retail, industrial, offices. We also do it on a geographic basis, so there is exposure throughout the UK. But we cannot concentrate all our investments just on the basis of where we think it is opportune to do so. What we're trying to do is obtain the best return for the fund. And historically, that has been in the southeast of England. And certainly over the last 2 years, the differences have been quite astute. Whereas there has been a malaise, let's say, in regional offices, the London office market has strengthened very considerably. It is therefore our job as investment managers to try and obtain the best return, and that is why, although we do spread risk, we have tended to concentrate on the more fluid and more liquid property markets.
I think you've also got to realise that actually those properties are the ones from a property portfolio, but within our equities, we've got investments in companies that own things like Meadowhall. So it's not that simple. And some of the other funds within the other bits also invest in property in one way or another. And I'm asking the officers, and I'm looking and talking to Greater Manchester Pensions Authority, who are also trying to look at this to see whether there is a way that we can invest in the local area where we make sure that there is a performance that pay your pensions, because we can't take so much risk that you don't have your pensions paid. So some of it is a balance between those things, but we are looking at those things.
Are there any more questions? Lady at the back.
Hello, this is the first time I've been to an AGM, and I do notice that the kind of age of most people here, from what I can see, looks as if it tends to be people who are retired already. I mean, I've just newly joined the ranks unwillingly because I was kind of forced out of my council job. But I do think it's, I mean, I'm glad it's kind of a reassuring bit from the administrator, but I do think it is fairly alarming that the opt-out rate is increasing. And I think as a scheme, you know, you were talking about doing, introducing new things and the EPIC and the various things. Do you not think it is very, very important at this point to be promoting the value of the scheme to younger members to prevent a drain out of the system or people not joining at all? And in that sense, to make sure that there is very punchy publicity saying, you know, what are the benefits, and that it is our right, that it is deferred wages. And in fact, one thing coming up to the strike on November the 30th, if we get a yes ballot, it's important, something that really brings it home to people is to have a ready reckoner to show how much people will lose if the government proposals go ahead. And I'm just interested to know if you have got a ready reckoner, because it brings younger people up against the fact of what this scheme is about and what the government proposals are and how damaging they are.
I went to the meeting with the employers last week, and this was one of the things we were discussing with the employers of how we can make sure that people stay in the scheme, and that they, across the board, all over 150 of them, were very supportive of saying, you know, it's a good scheme. We as employers want to be in the scheme, and we want our employees to be in the scheme. And they as a bloc, said, we want to be able to help as employers to keep people in the scheme, along with the pensions authority itself. So there is a joint agreement on this. The difficulty we have at the moment is where you can get the balance, in my view, between the trade unions saying, for some people saying, look, the scheme is going to change and we don't like it, but keeping keeping people within it. For some people, I think that some of them, it's very difficult of a message, and I think we need to all get together to say, look, this is a good scheme. But I think Gary's got some other things possibly to say on it.
I mean, we recognise this, and then this is why we earlier this year started to develop the opt-out strategy. And you know, it's easy to say opt-out strategy, but there's a lot behind it, and really it's a case of making sure that members are aware of the benefits of the scheme, the cost of providing similar benefits elsewhere, which are extortionate, and trying where we can. But you can only go so far. We can't give advice. We're not registered to give advice. But we have a panel of independent financial advisors that people can go to get advice on the scheme if we can't, as I say, we can't give it. But at the end of the day, the person who needs the cash will still opt out, and you know, we will do whatever we can. But at the end of the day, it's still a member's choice.
Thank you. Any more questions? Okay, ladies and gentlemen, I'm sure you'd like me to thank the chairman and vice chairman and John and Gary for their input and presentations this evening, and the other members of the Pensions Authority who are here. But equally, and perhaps more importantly, on behalf of my colleagues, we'd like to thank you for taking the time and trouble to come here this evening. We hope you've got something from the event, and as I said right at the outset, if there are questions that perhaps you know of a more personal nature you'd like to ask of colleagues, then they're going to be around for the next few minutes. We are in the process of laying the buffet out. If you could just give my colleagues a few minutes to get that, to pull that all together. But thank you very much for your attendance this evening, and a safe journey home. Thank you. I'd forgotten the answers to the questions. Sorry.
I don't know, the highlight of the whole evening. Okay, those of you with extensive wine cellars can answer this question. How many in the room put their hands up? 4,300. Well, I'm afraid you're wrong, sir. How many put 27,000 up? Again, you're wrong. The answer is £50,000. How many Chinese cities will have a population of more than 1 million by 2025? How many said 96? How many said 300? How many said 189? How many said 221? 221 is the right answer. Now, the picture is of the city of Chongqing, which is reputed to be the largest city in the world, has a population of 28.8 million. The bonus question was, how many Chinese cities will have a population of more than 5 million by 2025? The answer is 25. And that map explains. That is a graphical representation of the increase in population size expected by 2015. you'd see the big green bulge, which is China, compared to the rest of the world. Final question. Which is the most indebted nation on earth? How many put Zimbabwe up? Greece? Italy? How many put the UK up? Well, the UK is the right answer. Good night.